Hello, everybody, and welcome to Hurdle Rate. Today, we're going to go through a trading comp spreadsheet for big tech. The purpose is to see how companies are performing relative to each other and how the market is valuing them. So, first, let's go through what this spreadsheet entails. So, here we have a list of companies. We've got Adobe, Apple, Microsoft, Meta, Alphabet, etc., Nvidia, Uber, AMD, and these, all companies within the big tech large cap space. And what we've done is I've used the Excel data function to get the live stock price, the current shares outstanding, and the market cap. And I've added the cash and debt manually because with that, what we need to do is we take the market cap, we subtract the cash, and we add the debt to get the enterprise value. And why do we need the enterprise value? And that's basically a measure of the company's total value, the theoretical price you'd pay to buy the entire business, both for the equity and debt. And on this section, there's not really much to say on this, except that we can see on market caps, there's 8 of these companies have more than $1 trillion valuation. Nvidia is obviously racing ahead of all of these at 4.4 trillion, more than 4.4 trillion. And I mean, one thing we can note is that for the majority of the companies, the enterprise value is not a million miles away from the market cap, meaning that they're not really highly leveraged. I mean, you can see that maybe on Oracle a bit here. Look at that, 108 billion of debt with 11 billion in cash. Same with IBM, Broadcom a bit as well, but that's not really showing through on the market. Then again, on a $1.4 trillion market cap here, 30 billion difference looks quite small. But yeah, it's only really Oracle and IBM where you can really see the gulf between the market cap and the enterprise value. Next, I have then added in the top and bottom line financials for the last 3 years. This is fairly straightforward, and I have lifted those numbers from the financial statements. As we are not at the end of 2025 yet, I have forecast those myself based on trailing 12-month figures. This obviously leaves room for a lot of error, but we can update this as more concrete figures emerge. I guess we can say from these numbers that most companies are trending upwards across all three, the revenue, the EBITDA, and the net income, apart from, let's have a look, Tesla, which seems to be seeing its margin get hammered. And then also IBM, on the other hand, is actually, I mean, it's increasing. If we look here, it's increasing revenue, but we're seeing a decline in EBITDA and also quite a big decline in net income as well. I mean, this is certainly worth looking into at some point, and I might do a deep dive into that, you doing a DCF analysis on it at a future date. It's amazing to look at the revenues generated by the Mag 7 and how they compare to the market cap. Say, for example, Alphabet, Apple, Amazon, all generate significantly, nearly 2 to 3 times what Nvidia is generating. Yet it is Nvidia whose market cap is towering above them. I mean, look at that. Meta is making approximately the same as Nvidia in revenue. Yet Nvidia is valued by the market nearly maybe more than 2 times what Meta's market cap is. And yeah, I think that's very interesting. But just by looking at the numbers in this format, it doesn't really give us a clear picture of what we want to see. So let's look at the growth rates and the margin performance and see how they stack against each other. Now we get to the most insightful part. And I've used conditional formatting on this. So, I mean, obviously green is top performing and red is worst performing relative to the others. And I mean, what stands out straight away is Nvidia is performing exceptionally across the board. Even though it is seeing declines in revenue growth from 4.2% to 39%, the EBITDA margin's got from 66 to 56, profit margin from 55 to below 50. Even though those rates are declining, it's still significantly higher than all the others. If you look at Meta, which I mean is insanely profitable, it's at 40%. Nvidia is still 10% more profitable on percentage terms. And I guess this is where it does get interesting, because even though Nvidia does have insane revenue growth and phenomenal margins, and whilst they are declining, if we look at the rest of the Mag 7, ignore Tesla here, but the rest of the Mag 7, these seem to be increasing. So obviously, Apple here, the EBITDA margin is slightly up, and the profit margin is slightly up. Microsoft the same. Meta a little bit more, Google, well, Alphabet a little bit more. And like, whilst these are small moves, they are trending. They are trending upwards. And one of the things that I did notice as well was Apple's revenue growth is 4.5%. Last year was terrible at only 2%, but 4.5% I think is quite impressive this year, considering the media seem to be worrying about where do they go next. Whether that's product wise and with them lagging behind AI, where do they go next? So I think 4.5% is very impressive considering it's only, a little bit less. It's less than 2%. It's, yeah, it's less than 2% than what Alphabet did in revenue last year, which I'm significantly more bullish on. Um, Also, as well, you'll notice that Uber's EBITDA margin is less than its profit margin. And this is not usually the case. We expect the EBITDA margin to be higher than the profit margin. But in Uber's case, I think it's an accounting thing where they have to put in the value of investments in other companies, and that has to go there, which is why the profit margin is higher than the EBITDA margin. But also as well, I mean, look at Uber's profit margin. Look where it is now. I mean, gone are the days of them hemorrhaging cash left, right, and center. They actually look like quite a mature company. And then, yeah, I guess on the other things we need to look at, it's down at the bottom here. I've decided to use a harmonic mean because that sort of smooths out any outliers. Any extreme values are kind of, well, their effect is minimized. And we've also got the median down here as well. And I've done that because it allows us to see I guess when your mean differentiates so largely from your median, it usually means there's quite big outliers. But I mean, apart from on the revenue growth, which is obviously what Nvidia's caused, I mean the mean and the median seem to be in line with each other, which is good. Now we move on to the multiples, and this makes for a very interesting read. I mean, the first thing to say is Tesla and Broadcom look way overvalued, and you should definitely think twice about investing at these levels. And obviously, this is not financial advice, but I mean, 191 times earnings, and that's increasing from last year. Yeah, does seem a bit risky. But the others, I mean, the rest are trending towards healthy multiples. Apple, Microsoft, etc., have their multiples coming down. Meta and Alphabet could actually be. I mean, look how green they are. They could actually be quite undervalued based on their margins. Not necessarily on revenue for Meta, but certainly on the EV to EBITDA and the PE ratio. And I guess obviously we have to talk about N Nvidia because I mean on a EV to revenue, this is huge, but they are going in the right direction, and it is possible that in a few years, I mean, it's still a long way to go, but within a couple of years, these could be trading at the same multiples as Microsoft and Apple. I mean, and if we look on the average again, here they all seem a bit. I mean, they seem in line with each other. But what is interesting on the EV to revenue is the median is higher than the mean. And I think this is because you've got several companies such as Amazon, Uber, I mean, even IBM that are trading so much lower to the rest, and they're really bringing that down. So yeah, so that's why we have that. Now, if we take the industry average on the multiples, well, both for the mean and the median, we can project a price based on if the company was trading at that level. Again, this is by no means financial advice, and you should not invest because of these projections, but they are interesting to see which companies are currently priced above and below market averages. We can see that Adobe, Alphabet, and Amazon look to be undervalued across the board, as does Salesforce. And I guess, should it revert to an industry average, Nvidia could have a long way to fall, as do the other chip makers, AMD and Broadcom. Um, what else? I mean, Uber's a bit strange because look at the range on this. On the EV to EBITDA, it's trading at 86, 80, which is actually not far from where it is now. But if you were to put it on the average EV to revenue or the average PE, it shows that there's considerable upside. But the PE we can't really take into account because when it's showing the net income from well, as we said earlier, from other investments, these aren't necessarily realized gains. So it's not actually income that they've made, but it's also, as well, those gains are not necessarily going to be around every year. So we can't really trust the quality of those earnings. So we should probably, look at, say, well, attach more weight to the EV to EBITDA ratio or the EV to revenue for Uber rather than the PE ratio. Anything else? No, I think that's it for today. I'll make this spreadsheet available to download so you can have a play with it. And yeah, we'll revisit it maybe in a couple of months on the next batch of earnings, and we can see what's changed. But that's it, and I'll see you on the next video.